In today's session, we're going to look at some of basic accounting concepts. We're going to look at what a balance sheet is, what an income statement is, what the double entry system of accounting is, and how we use the double entry system. The first thing we're going to look at is a balance sheet. A balance sheet is one of the main financial statements. Balance sheets are recorded as at certain dates. So this balance sheet that we are going to look at is as at the 31st of December. So for a business, their balance sheet will basically show what the company owns and owes at this date. The balance sheet sections are split up into assets, liabilities, and capital. Assets are things that the company own. For example, property, equipment, or motor vehicles. Other things the company own are things like money, cash. Liabilities then are things that the company owes. So they could owe money to the bank in terms of a loan. They could owe money for a mortgage. They could owe money for things that they've bought on credit, and that is known as accounts payable. Capital then is money invested into the business by the owner if it's a sole trader, and shareholders if it's a limited company or PLC. The second financial statement we're going to look at is the income statement. And it is different because an income statement looks at a period of time and how much wealth has been generated in that period. So this one we look at the income statement for the year ending 31st of December 2016. So as you can see, the balance sheet is as at a certain date, but the income statement is for a period, and in this period it's for a year ending the 31st of December. And it looks at different things. It looks at revenue or income. This is how much the company has made during that period. It could be sales of assets or sales of inventory. It could be sales of services, depending on what the business does. It then looks at cost of sales, and that's how much the sales cost us, the business. So for example, if you sold a dress, the cost of sales would be the material and the thread and the buttons that you had to purchase to make the dress for you to sell it on. So for example, if we had revenue or income of £1,000 and the cost of that revenue to us as the business was 500, this gives us a gross profit of 500. Then the income statement then looks at other expenses, and these can be also termed overheads. And these are things that you need to make the product or the service, but they're not directly in the product or service. So in the example of the dress, we needed maybe a machine to make the dress, which needs light, which needs heat, which needs labour of a person. So expenses or overheads are things like light, heat, wages. There's many other expenses, and we'll go through these as we go on with the examples. Once all these expenses come out, so for example we had light expense of 50, heat expense of 100 and wages of 50, this is then left with our net profit. So in this example we would have a net profit of 300. We will go into this in more detail, but I just wanted to give you a brief introduction to the two main financial statements. we are now going to look at how numbers get put into the financial statements. So every transaction within a business has to be recorded. And we're going to look at how this starts. So as I said, every transaction within a business has to be recorded. And this is recorded in things called ledger accounts. This theory, or this policy, stems from the business entity principle. And this principle basically says that a business is completely separate from the owner. And in our case, we will be talking about a sole trader, where one person owns the business. But with the business entity principle, the business and the owner are separate beings. So anything the owner owns, that does not mean that the business owns it. So that means that a business has nothing until the owner invests money into the business. So the very first transaction of any business is where the owner borrows money to the business. So the business is getting money from the owner. So in this example, we'll say the owner has invested 10 grand in the business. The business now owns 10 grand, but he also owes this back to the owner. So this basically means that things owned by the business is equal to an amount owing to the owner. And another term I will use for owner is proprietor, especially if we're using the sole trader example. An example of this would be if you yourself borrowed money from your friend. You would own the money of £100 or €100, but you also have a liability to your friend of €100. So what you own is the same as what you owe to your friend. And that's the exact same first transaction of any business. A business gets money from the owner, so the things that the business owns is equal to the amount owing to the owner or the proprietor. Things owned by the business, as mentioned in the balance sheet, are called assets. So this 10 grand that has been given to us by the owner is the business asset. And that is equal to the amount owed to the proprietor, and that is called capital. Capital is the amount invested in the business by the owner of the business, and that is the start of our balance sheet equation. Our full balance sheet equation is net assets is equal to proprietor's interest. But how did we get from here to here? Net assets is assets minus your liabilities. And proprietor's interest basically is your capital. So how are we going to show this? Is we're going to go through an example of a business starting off from scratch and how these transactions are recorded. And the example is called Chris Toffer. So Chris Toffer has 1,500 in cash and he wants to invest that into his business. So what does the business now have? The business has cash of 1500 and capital of 1500. So our assets equal our capital. So our balance sheet equation holds true. Then Chris wants to put some of the cash into the bank for safekeeping. So he wants to put 14,1450 into the bank. So basically his cash balance is reducing by the 1450, but his bank balance is increasing by the same amount. So how does his assets and capital look now? He no longer has 1500 in the cash. He only has 50 because he took out 1450. But that has gone into the bank. So his cash is reduced, but his bank is increased. His capital hasn't changed. He still owes 1500 to the business still owes 1500 to Chris. So his capital is staying the same. So again, his assets equal his capital. In that example, he has converted one form of asset into another. He has taken the sum of cash and put it into the bank. So you can see that the bank balance was impacted, and so was the cash balance. And as you will see as we move through these examples, every transaction will impact two items. Number 3 then. Chris then decides that the business needs to buy property so that it can trade. They see a property for 5 grand, but they don't have enough cash in the bank or on hand to buy it. So he needs to borrow 14,000, or he needs to borrow an amount from the bank. So he goes to the bank and asks them for 4,500. How has that impacted his items in his financial statements? His cash balance hasn't changed because the bank hasn't given him 450 in cash. But his bank balance is now increased by the 14,500. So he had 1450, but the bank has now given him another 4,500, so his bank balance has increased. So he has an increased asset in the bank. His capital has not changed because Chris hasn't borrowed any more or taken any out. But what now does he have? He now has another liability to the bank. And that is for 4,500. So does our balance sheet equation still hold true? Our assets are now equal to 6,000. And this time we've got a new liability. Our capital and our liability are equal to 6,000. So that is an extension of our initial balance sheet equation, and we're working our way towards the final balance sheet equation. So our assets are equal to our capital and our liabilities. Everything still balances. That transaction hit our bank, and it also hit our liabilities. The business now buys the property. And that cost them 5 grand. How is our balance sheet impacted? Our cash balance hasn't been impacted because we bought the property using the bank money. So our bank did have 5,950, but we bought something at 5 grand, so it's reduced by 5 grand. So we're only left with €50. Sorry, €950. But now what do we have? Our bank has gone down, but we now have a property asset as a result of this transaction. So our property value is going to be put in at 5. So again, we're converting one asset, i.e. the bank, into another asset, i.e. the property. Our capital hasn't changed. It is staying at 1,500. And our liability hasn't changed as we haven't repaid the bank. Does our balance sheet equation still hold true? Our assets of 50 plus 950 plus 5 is still giving us 600, so our assets are still coming to 600, and our capital is still coming to 600. So our assets still equal our capital and our liabilities. The next transaction for the business is that they buy goods for resale. So they want to bring goods in to sell. So the business buys goods for resale. And when I say resale, it means they're going to sell them on in the normal course of business. And they buy them for €100 on credit. This basically means that they get the goods in, but they don't pay for them yet because they're buying them on credit. So the supplier, or the person they've bought them from, has given them 30 days to pay. How will this impact our items? Cash won't be impacted because no money has come out of the cash balance. Bank also won't be impacted because we haven't actually paid for the goods yet. And our property won't be impacted because we haven't increased our property asset. So they are not impacted. Our capital isn't impacted because we haven't got any more money from the sole trader. And our liability isn't impacted. Our liability is impacted because we owe 4,500 to the bank. But what now do we owe? We owe €100 to the supplier or the person who gave us the goods. What haven't we put in? We haven't put in the goods. So, for this liability of 100, we now own another asset. We own inventory or goods. So, the two items impacted in this transaction, our inventory has increased and our liability has increased because we now owe the supplier for the goods. So our asset balance is coming to 6,100 and our capital and liabilities is coming to 6,100. So our balance sheet still balances. Our inventory has gone up and our liability has gone up. Always think about each transaction in the sense of two items. What two items have been impacted? The next transaction is the business sold the goods. So he sold the goods that cost him €100 for 175. A business would never buy goods in and sell them for the same amount. Why not? Because they want to make a profit. How will this impact our balance sheet items? Our cash won't be impacted, but our bank will be impacted. Why? Because we have received €175 from a customer. Our property, I'm just going to change this because the bank had €950 in it. So 950 plus our 175 will give us 1125. Okay. Our property won't be impacted because we still have our property and it's still valued at 5. But what will happen to our inventory? Our inventory is no longer there. So our €100 has reduced to zero because we sold it. So the two items impacted in this transaction is our inventory has reduced, but our bank has gone up by the 175 that the customer has given us. Our capital hasn't been impacted because we still owe Chris 1,500, and our liability hasn't been impacted because we still owe the bank £4,500, and we still owe the supplier €100 for the goods that we bought. So does this still balance? We've 6,100, but in our assets we've 50 plus our 1125 plus our 5 is 6175. So what's the difference? What's the €75 difference? It is the profit we made on the goods. And any profit we made on the goods is reinvested back into the business through the capital line. So our balance sheet now balance. And in that transaction, our bank was impacted and our capital was impacted. So Chris and his business made a profit. They bought goods in for €100 and then they sold them for €175. So they made the profit of 75, and this is reinvested back in, as I said, through the capital line. The last item we're going to look at then is Chris then took money out of the till. He took €25 to celebrate his profit. But remember, Chris is not the business, so this transaction has to go through. And if a proprietor takes money for his own use, this is called drawings. How will we show this in our balance sheet? Our cash will be impacted. Our cash will reduce. So we'll have €50 and that will reduce by the 25. Our bank won't be impacted. We still have our 1125. Our property won't be impacted. We still have the £5,000. And inventory is still sitting at zero. Down here now, we have our capital plus our profit coming to 1,500 plus the 75 profit, 1,575. And we still have our liabilities. Our £4,500 to the bank and our 100 to the supplier, because we still haven't paid for that yet. So does this balance? We have our 25 cash, our 1125 at the bank, and our 5 in property. So our total assets is coming to 6150. But in our capital and liability section, we only have 6175. So there is a difference of €25. And this is the other side of the transaction in relation to the drawings. So drawings is money taken out by the owner, and where that is shown is in the capital section as a minus. So our capital, you add on profit and you take off any drawings. So now does our balance sheet balance? Yes. So your capital section is impacted by two things, profit and drawings. And now we can go and look at our final equation. In this section, last example, our assets were equal to our capital plus a profit minus our drawings and our liabilities. So I'm just going to write that out. Assets of all different types is equal to your capital plus your profit minus your drawings plus your liabilities. These three items together are known as your proprietor's interest. So the way this equation is termed is we take the liabilities over to the side of the assets, and your assets minus your liabilities is now equal to this proprietor's interest. Assets minus liabilities is termed net assets. And that is your final balance sheet equation. And this should always hold true because every transaction has two sides. So in this session, we had a brief overview of the main financial statements, the balance sheet and the income statement. And then we then talked about how every transaction is put into the books of account with two sides. And this is because of the business entity concept, where every transaction has to be put into two accounts or touches two accounts. And because of this, the balance sheet equation will always hold true. We then looked at a number of examples through the use of the Chris Toffer business on how this balance sheet equation started as assets equals capital and extends to net assets equal proprietor's interest. Remember, proprietor's interest is your capital invested by Chris plus any profit made by the business minus any drawings that Chris took out for himself. The next session will then look at how we record each transaction as a debit or credit. In this session, we talked about it as increasing or decreasing accounts, but the technical accounting term is that you debit or credit an account, and we will do that on the next session. Thank you.